Hello everyone, Jeff here with some bond basics. A bond is issued by a government or a corporation when it needs to borrow money. Like most other loans, it requires the issuer or the borrower to make periodic interest payments and at some point pay back the amount that was borrowed. You can imagine this green box here as a piece of paper representing the bond, and it's got some information on it that we need to decipher. First of all, this is a Jeff Corp bond, so a corporation issued by a corporate bond issued by Jeff Corp, who needs to borrow some money. And that top value there, $1,000, we're going to call the face value, or depending on who you're talking to or the textbook you're using, can also be called the principal value, par value, or maturity value. It essentially is the amount that the corporation has borrowed, but for your purpose, the most important thing about this number is that it's the amount that the bond will pay back at its maturity date, which is given at the bottom there, 10/1/2023. The next important figure on here is 6%, which is called the coupon. Along with the face value, the coupon establishes the amount of interest that you're going to receive. 6% of $1,000 is $60, and that represents the annual interest payment. However, most bonds pay interest twice a year, so this is $60 a year, will be paid as $30 every 6 months. It's usually based on the maturity date, so in this case it would be every October 1st and April 1st, which is 6 months from then. Lastly on there is the maturity date. If you are holding this bond on 10/1/2023, you will receive the face value $1,000. An extremely important thing to remember about bonds is that when you purchase a bond, you pay the market price, not the face value. So a bond, like a stock, is traded in a market. Its price depends on a number of things. For bonds, mainly interest rates, but also the strength of the company, supply and demand, liquidity, all sorts of things. So the actual price of the bond when you purchase it or sell it before the maturity date is going to be some other value established by the market. It might be more than $1,000 or less than $1,000. Looking at interest rates to try to figure out why the price might fluctuate, let's think about this bond that, let's say, was issued on 10/1/2013, and so its maturity date is 10 years after that. Let's say that this bond was issued, and then after it was issued, most other interest rates in the economy went up. So you're looking for something to do with your money, and you have a bunch of options. One of the options is to purchase this bond, which has a 6% coupon, and all of your other options pay higher interest rates because interest rates have now risen since this bond has been issued. That means all of your other choices for your investments are better. They're paying higher interest. So this bond is not as good as it used to be. The only way you could get someone to ever purchase this bond would be if its price went down. So here we have, if other interest rates in the economy rise, this bond becomes less valuable and its price will go below the $1,000. On the other hand, if other interest rates in the economy fall since this bond has been issued, that means this bond is better. Again, you're looking for something to do with your money. This bond pays a 6% coupon. Other choices for your money now are not as good. This makes this bond more valuable, and its price will go up above the $1,000. If the price of the bond does go above $1,000, we call it a premium bond. You are paying more for it than its face value. And if the price of the bond goes below $1,000, we call it a discount bond. You are paying less than $1,000. Finally, one other piece of information that we may want to know is called the current yield. The current yield is what you get when you take the annual coupon amount, the $60 a year, and divide it by the current market price. And as an example, let's say that this bond is $950 in the market. That means that you would pay $950 for it. We take the annual coupon amount, $60 a year, divide by that current price, $950, we would get 0.063, which is 6.3%. So one thing that needs to be stressed here the coupon amount, the $60 a year, is established permanently by the face value of the bond, in this case $1,000, and the coupon on the bond 6%. You are going to, by holding this bond, you are going to get $60 a year paid as $30 every 6 months, no matter what the market price of the bond is. No matter what you paid for it, no matter what happens to the price before or after you buy it, it is going to pay out $60 a year that is fixed by the face value, which never changes, and the coupon on the bond, which never changes. The current yield is going to go up and down because the price of the bond changes. But again, that's just a measure for people who are currently looking at the bond. If you are holding it, always $60 a year paid as $30 every 6 months. And if you hold it to maturity, $1,000 on October 1st, 2023.